Well, as you can see, this is the first, I think this is the biggest of the panels that we've got today, which explains the extemporizing and finding the chair. It's entitled The Impact of Regulatory Change and Market-Led Initiatives, Charting the New Landscape. Now, I think this is important. We've talked a lot about regulation, but the market-led initiatives are also very important. And we've got a high-level panel to my right, divided between the two representatives of the CCPs that you've already met, Urs Wieland of SISX, Clear, and Hugh Brown of EMCF, and then joining them two members of ICSDs and Marta Calado from Interbolsa, the Portuguese CSD. So we've got the settlement side, and Robert has come up and joined us, who is the representative of the users, characteristically holding the microphone at the end. Now, I'll introduce them one by one so you know who is speaking, who they are as they speak. On the far right, as I say, Robert Barnes of UBS with the microphone. All the CVs are in the papers, the documents you've got, and you don't want to hear me expound on the virtues of them all. Take that as read, because otherwise we'd never get on with the panel. Next to Robert, Marta Calado of Interbolsa, the Portuguese CSD, the only CSD, I think, in the Euronext group. Is that the case? Urs Wieland, we've already met, of SISX, Clear. Tim Howell, CEO of Euroclear, ICSD based in Brussels, also a group that has many CSDs. Hugh Brown we've already met, and to my right, last but certainly not least, because he's going to speak first, Mark Gem of Clearstream and Clearstream International in London. Now, I'm asking, it's a slight variation on the order of service in the agenda that you've got, but as Tim is starting a panel later this afternoon, I thought we should ask Mark to start now. So I'm going to ask each of the panelists to say a few remarks. Very briefly, I hope, because 4 to 5 minutes, we've got a big panel. We haven't got that much time. I know you'll be wanting refreshments at 10 past 11, and also we all want to have the questions and answers. So, Mark, we've got a lot of questions that our organisers have set before us. Pick and choose. Where do you want to begin? I think the reason I asked the settlement side to talk first is we've had two CCP representatives talking already. Also, just in this last week, the European Commission, after some considerable delay, produced the first ever proposals for a regulation of central securities depositories. And I think the reason there was some delay, there was quite a lot of controversy. So maybe that's where we should start. We're going to have a panel later about CSD specifically, but this is such an important instant issue. Are you happy with what's come out from Patrick Pearson and the rest of the team? Patrick, by the way, is sitting at the back, busy monitoring everything we all say, and he will be bringing the conference to an end at the end of the day. So, Mark.
Well, to answer your specific question, I mean, CSD regulation, there's much to love, much to like, much to question, I think would be how I would respond to that, Peter. Overall, I couldn't agree more with much that you said, Frank, that what we're looking at is an agenda which is characterized by a real commitment, especially in Europe, to the reduction of systemic risk, whatever that may mean. It's supporting, of course, an agenda among market actors that you quite rightly and properly said will focus on capital efficiency. And within that, the question then becomes, what does that mean in terms of implementation? What does that mean in terms of convergence and divergence? And in many ways, CSD regulation is, in microcosm, kind of isolates many of those issues, many themes which we will find elsewhere on the market, whether we look to the response of the authorities and of the financial sector to the financial crisis to the Eurozone crisis, whether we look at such initiatives as T2S, whether we look elsewhere into the longer range effects of EMIR and Dodd-Frank, and I certainly don't want to add to the very lucid remarks you made there, but CSD regulation is very interesting. From a kind of concentration perspective, the case for CSD regulation is obvious. There are no uniform licensing or access regulations in place in Europe. It is much easier to, for example, open a CSD in, say, Luxembourg. I know that because we've just opened one called Lux CSD in Luxembourg, than it would be in Germany, for example. And I say that because we operate a CSD in Germany as well. There is a need for uniformity. There is a desperate need to ensure that CSDs are guaranteed access to each other from what I guess in CCP terms you will call interoperability, but we would call much more prosaically links. These things are absolutely essential. There are also some very good things, some tidying up things in the regulation. For example, immobilization, or what the draft regulation, the proposal calls book entry securities.
Getting rid of the paper, in other words.
Getting rid of paper, and getting rid of things which aren't in CSDs at all. But where it gets much more problematic is on the systematic risk dimension. Because let's just look at it from that perspective. Firstly, well, the question I would say is this a solution looking for a problem? Because in what sense did the CSDs fail the systemic risk agenda during the crisis, during the euro crisis? In what sense do they represent a risk? And the response that is embedded in the proposal is to say, well, because in some cases they undertake banking activity. And that presents a number of implementation dilemmas that bring up many of the themes that we've touched on this morning. I mean, the first is that in reducing systemic risk, is it correct to eliminate risk from the system if the price you pay for that is to transfer that risk into the financial services sector? Because that is in essence what CSD regulation is proposing. It is to say a CSD in settling should not undertake banking services that are ancillary to settlement, and certainly it should not undertake other banking activity. Now, of course, the banking side of settlement, in particular the formation of the ICSDs, like the formation of the CCPs, was designed specifically to absorb and net out systemic risk. So there you have a contradiction in the first place. So we have to be very careful whether we are reducing systemic risk or whether we are transferring it to actors who are in the process of deleveraging and in the process of trying to be re-rated. That is an issue. Now, what's particularly interesting is what that means for the convergence agenda. Now, we said, and I think Mr. Barnier said it at the press conference when CSD regulation was announced, that it's one of the objectives of CSD regulation is to ensure a convergence with the US, by which I assume he meant a standardized process. But let's just consider that. In the US, you have a single CSD for cash products, DTCC, which settles in, guess what? Commercial bank money. Participants hold cash accounts with DTCC. Then let's look at a systemic risk issue which is being faced in the United States at the moment, the so-called repo reform issue. The repo reform issue is a technical issue relating to the tri-party repo world, where repos, so-called term repos, are rolled over on a daily basis with up to 4, 5, even 6 hours of open daylight risk on each rollover, okay? Technical issue to be resolved. In the US, the response was to encourage DTCC, at least initially, to consider whether it had a role to play in managing that repo problem. So in the name of convergence, we get the prospect of divergence. And I think we can see that in many of the themes that we'll touch on this morning.
So yet another aspect of divergence across the Atlantic. I'm sure, Tim, later you may want to address some of the same points, but from a different angle. But Marta, in the meantime, you're a CSD, but you're not a bank. So presumably the new regulation has some rather different attractions or other aspects for you than maybe for Mark.
Yes, absolutely. I think the good part about being a speaker after Mark is that I don't need to talk about the general aspects of CSD regulation because he has them covered. I think we are pretty much aligned in terms of European CSDs on the challenges that CSD regulation brings to the markets. Of course, being an ICSD or being a national CSD does bring different challenges. And as a CSD and talking about CSD regulation, I think one of the key things that for me it is important to mention is that it is honestly my sincere belief that we could keep on working very well without a CSD regulation. I do not think that the CSD regulation was mandatory. As Mark said, CSDs proved to be very resilient during the crisis. They are already strongly regulated, both by national regulations, by European standards, by international standards, and even industry standards. And therefore, there was not a real practical need for such a regulation. Notwithstanding, we do understand with MiFID, EMIR, having all infrastructures being regulated by European regulations, not having the same situation for CSDs, was an unusual situation. And therefore, we do understand and we welcome the regulation, as we do believe that it has positive aspects and it does have a role that is to be valued in terms of harmonization of rules. And in the end, we do think that one issue that we have to be worried about is in fact the harmonization. Because just to give you an example, if we take Article 47 of the CSD regulation in terms of access of issuers to CSDs, the regulation says issues should have the right to register their issues in any European CSD. This article is introduced with the objective of eliminating Giovannini barrier number 9, which is perfectly fine and fair, but it doesn't really achieve that goal, because the true barriers are still there. They are part of the national rules and legislation. They are not going to be automatically removed by the simple fact of the approval of this regulation. And what this regulation might actually achieve is that the harmonization that is trying to accomplish will be distorted. For example, if a country does have rules and regulations preventing de facto for issues to be issued somewhere, just the fact that you have a regulation saying this rule is now abolished, the corporate law that exists in a country will still be there. Yeah. There will be implementation to be done in each national country to make sure that this objective is achieved. And I hope that this happens, but in this case I think that this approach should be better addressed and better analyzed and ensure that all existing barriers are in fact lifted, that they are lifted at the same time in all national member states, and that in fact a fair level playing field exists for issuers on one side and fair competition exists on CSDs on the other side, because that in the end is the objective of this regulation. And this is just an example. There are other areas of this regulation that have good objectives that are to be appraised, but in fact on its own, on themselves, are not enough and sufficient to really achieve the objectives that are set to accomplish. And I think as a CSD, national CSD, that does not have the challenges of ICSDs in what regards banking licenses, that is an aspect that also worries us, because in moving forward in our business, who knows, maybe tomorrow, in 1 year, in 5 years, that would be something that we would envisage. And therefore it is important that entry barriers are not being put in place, that CSDs are able to continue to do their business as they always have done. But of course challenges are different when you are a national CSD, and at this point what worries us in the most are these aspects of the regulation that in the stride of harmonization, they really leave behind the implementation process and how the national rules and regulations need to be addressed as well, ensure to guarantee that a fair level playing field does exist for all CSDs. Thank you.
Thank you very much, Marta. Tim, do you need the microphone, or are you mic'd up?
I am indeed mic'd up. I believe
good,
it's working.
Good. I mean, listening to Mark here, I mean, what he was too polite to say bluntly was that an ICSD like Clearstream or Euroclear is much safer than the banks.
I didn't say that at all.
I know you didn't say that. That seemed to be implicit in what was there. I guess that looking at this regulation in its draft form, I mean, there are provisions that allow you to continue your business as it is at the moment, are there not? Providing various conditions are met. And on the other hand, I mean, there's an awful lot of money slopping around in your international central securities depository during the day. I think 80 billion euros, is it? That seems a lot of money to perhaps,
okay, well, let's
not be regulated.
I mean, clearly I have a lot of sympathy, as often said so far. The only line I have fundamental problems with is Mark describing the CSD legislation as generally interesting. It is difficult, I think, the CSDs, we spend a lot of time saying we were not a source of systemic risk. Therefore, there was no real reason for doing this sort of regulation. Whilst I have sympathy with that, I think it's kind of not the strongest argument. Again, I suspect if you'd asked Lehman's in 2006, they'd have said something reasonably similar. So I do think that I understand why people wanted, as it were, to tick that last box. Do I think it fundamentally changes the landscape? No, I just don't. I mean, I suspect when we get through all this, we will then stand back and say, is the cost worth the effort? And I think it'll be a fairly marginal judgment. My concern with them is that there's always chances of unintended consequences. And these rear their heads all the time. And again, following from what Mark was saying, principally when you look at something in isolation. And so if you're looking at something in isolation and say, wouldn't it be a good idea to take all the banking activities away? I can kind of see how someone could come to that conclusion. If you then look at the industry as a whole, i.e. securities and finance world as a whole, you can then say, well, actually some of these things are done in order to alleviate systemic risk. You're kind of passing it from one part to another part. Therefore, are you indeed increasing risk? Now, to be fair, I think that one of the reasons for the delay in the regulation is that people are becoming more and more aware of that. So following your point, Peter, are there ways in which you can come out pretty much as you go in? Yeah, it looks like it. We need to wait and see what the details are and how much work you have to go through in order to argue the case. I think that kind of circles me back to the beginning, which is if you end up with where you are, you wonder whether it's even worth going down the path in the first place. But let's put that to one side and say we are going down the path. That's just a fact of life. I also think that generally, the way a lot of the regulation on the CSD world, which I think is somewhat different from some of the other regulations, say with CCPs, is that it's kind of, if the principal reason is to produce something like a common standard on safety, it's kind of hard to argue against it. You may disagree with individual bits, but as a goal, that's not an unreasonable goal. And so you're not going against the grain with doing that. And that's the sort of thing which the CSDs and ICSDs have been doing for a long time. And so in that sense, as far as what's the impact on the CSDs, you don't get killed by the train you see coming. This is a continuation about what we've been doing for a long time. You understand this, you've already taken some action on it. And I think it is worth remembering at this stage that the CSDs and the ICSDs have really moved on over the last few years. I mean, our business now is far more to do with risk, managing risk, helping people manage risk, and providing information. We're no longer just being paid to do the process of settlement of asset servicing, which frankly is quite good when you think about it, because the ECB want to take away the settlement, and the CSD directive could have an impact on some of the ancillary services. So I think I understand why we're going down this route. Do I believe it would change the landscape dramatically? No. Do I believe there is the possibility of tripping up on unintended consequences that could have an adverse impact? Yes, and it's our job to make sure those things don't happen. An overall comment I want to make, though, is that risk management and risk looking in a systemic sense has to be part of the DNA of infrastructural type organizations. To some extent, that differentiates them from straightforward, pure commercial organizations. And if you don't have that infrastructural DNA, infrastructure is about trust and about risk management, if you don't have that on the DNA, frankly, regulations won't give it to you. And so the idea of the regulations working alongside, working with, is fine. But that is not going to replace the underlying characteristics and DNA of an infrastructure organization, which should be really based around risk management and to do with trust rather than pure processes. So we will see how the detail works out. I think as far as the first draft goes, frankly, I've seen a lot worse, usually the earlier drafts, and so we will all move on from there.
Well, thank you very much, Tim. This talking about risk management being in the DNA of an ICSD and CSD as much as the CCP is a wonderful way of segueing into Urs, because you've before you took over as SIS Clear's CEO last summer, I think you were very active on the securities settlement side. So you've seen both sides. You've also seen the emergence of EMIR from a view slightly outside the European Union, but obviously very much participating in it. So where do you stand? We're now moving more into the CCP side of the panel, I guess.
Yeah, honestly, I had always a little bit the impression we are in some areas more Europeans than the European itself as an outsider country. So what is a fact at the moment, and what I see internally in Switzerland, that our regulators will follow to the new rules and regs in Europe more or less by 100% with a Swiss finish. What does it mean, a Swiss finish? A Swiss finish means always something on the top. But this is something which I have to deal internally with my own regulators. But coming back to your question, what does it mean in terms of risk management? You're right, I was also responsible for risk management and in a CSD, ICSD environment, and therefore I'm fully with you. This is a key topic which we have to look into it. The tendency which I see, and I can only speak for my own sister company, we have to remove the risk from the CSDs in some or the other way around it. What we have done internally, we have removed some kind of uncovered exposures. We have done that in the last couple of months. And this is the way how a CSD should go straight forward. It is not, from my point of view, the aim of a CSD to take over risk from the market. This is not the aim of a CSD. A CSD has other aims which they have to fulfill, not taking over the risk. This is a purely, from my point of view, a purely thing which should be covered by CCPs or commercial banks, not on a CSD level. what does it mean in practice, the new regulations? From my point of view, from CCPs, what I expect is to have a level playing field. And to be honest with you, I don't care about if the regulations are more harsh or not. As long as we have a level playing field, I can deal with that. As long as all my competitors have the same rules, and as long as the whole market itself will act in the same environment, I don't have a problem to follow that. It might be a complete different view if I change my place and change to the place of my clients. My clients are directly affected, and it's without doubt. New regulations create additional costs. It is not possible to have a new regulation, additional safety to the market, mitigating risk without having the additional costs. What does it mean? It means that each layer in the post-trade landscape, starting at the CCPs, going back to the CSDs, also to the general clearing members, to the global acting clients, all of these will ask for more collateral, for more safety, and this is not for free. It's not a free lunch. So you can reduce on one side the fees in terms of competition. That might happen. We have that example in our own CCP environment. We saw that in a very dramatical way. To give you here a figure, when we started in 2003 with our business, we have meanwhile reduced our fees by around 95%. You can argue that the initial price was too high, might be, but I think we are now at the end of the lane. So, additional safety and mitigating risk costs always.
It is very
and the market has to pay for that. That's a very short conclusion.
But it's a very interesting case. The fall of your fees is a sign that although there's this great regulatory change, that market-led initiatives, the competition has come through as well, which is probably a good time now to ask you to intervene again. One of the themes that came up in the strategic forum and wasn't really addressed in questions was this issue of and fortunately it's on the screen behind me, of whether, consolidation is ahead of us. You yourself, you're in a company that has often been mentioned. Well, it's known that your largest shareholder, the Dutch government, is keen to see somebody else take it over. And I mean, we could have been sitting on this panel a year ago and I'd make exactly the same statement. I mean, are we looking at consolidation down the line as a result of these initiatives? And if so, when and how much? I mean, we heard Frank talking about, and I think Urs as well, that the number of CCPs is going to drop, but it's a question of when and what on earth is going to happen to those that are going to presumably not fall by the wayside, but be taken over, or what happens to them?
Thank you, Peter. I'll address that one briefly, and then I also wanted to take advantage of having the CSDs on the panel to ask a kind of CCP CSD question. In terms of consolidation or proliferation, I think we've already had some benefits of consolidation, even though that hasn't necessarily been apparent. But there are people now who are thinking of building their own CCPs for their equity markets, who are looking around, looking at the economic case for doing so, and saying no. So I think we've had a benefit of that already. In terms of whether there will be further actual consolidation, yes, I think I mentioned we're a commercial company. I think all commercial companies ultimately have a price on on them. If the price is high enough, the commercial company is sold. I think a lot of other CCPs and other market infrastructure companies, that's less clear, whether by dint of their complex shareholdings or what. It's good that the future of LCH at least seems to be being resolved, and we certainly welcomed the commitment to horizontality from London Stock Exchange Group in that. So yes, I think there will be some consolidation. I think it's not as easy as just pure economics with a lot of them, though. There's a lot of politics and wider strategy involved. The thing I wanted to pick up with the CSDs on the panel is, as a result of interoperability and its gaining ground from a CCP side, we now find ourselves, the CCPs, with significant settlements between us. We're always large settlement players, but now we have significant settlements between us that we have to fund ourselves. And I think Urs will correct me if I'm wrong here, but this works out towards €2 million a year for each of us. Yeah? And so this is unfunded. This is something we have to take out of our own profits. And I guess CSD settlement fees have not really come down in the way that CCP fees have. It's difficult for them to do so because they're not seeing the massive growth in numbers that the CCPs have seen through lower costs of trading. I think that the question for the CSDs is perhaps those settlement volumes will go down even further. Because now what we're seeing from customers is, yes, I like the service you've got for my MTF and my exchange settlements. Now can I give you my OTC settlements as well and benefit from that efficiency too, which will further concentrate and reduce the settlement volumes at the CSDs. And I wonder how the CSDs are looking to address that in the context of recently mooted competitive pan-European CSDs from new entrants. That was...
Well,
they can come back to that.
Do you want to come back to that, or should we move to you, Robert, next? Perhaps let's let Robert have a go, because behind me as well I see something that says, will new regulations succeed in promoting better outcomes for users? We've heard a lot about the CSD regulation. We haven't touched so much on EMEA, but we're not so much a derivatives group up here, OTC group. But Robert, as the user on the panel, how do you feel about all that?
Well, thank you, Chairman, and good morning, ladies and gentlemen. I would like to thank Marketforce for inviting a humble practitioner to address such a distinguished audience. So, ladies and gentlemen, we're trying to work in partnership with the exchanges to promote liquidity in new business. And we thank the regulators because they provide the framework within which we can behave as entrepreneurs. So the first observation is that there are different roles for CCPs, for cash and derivatives products. And this is because it reflects the different risks of these products. For example, cash equities tend to settle in Europe between 2 and 3 days, whereas derivatives have much longer times to expiry. So it makes sense to have different frameworks. And for those of you that are interested more in the interoperability and cash discussions and the case study of our UBS MTF, we will have another panel, I believe, Chairman, after lunch, and we will have a very dynamic discussion. But ladies and gentlemen, all of us in this room, as an industry, are facing some mandatory obligations on over-the-counter derivatives. And what's very interesting is that bodies like IOSCO, on the 29th of February, just published a series of 17 principles and recommendations for the authorities worldwide around mandatory clearing of OTC derivatives. This is very helpful. And ladies and gentlemen, many of us, if not all of us, are currently involved in the ESMA questionnaire due this Friday, taking a look around the frameworks. And the key message, if I can share this as a student of the markets, the ESMA message, the European Commission seems to be talking about supporting financial stability in a fair and efficient market within the regulatory framework. So ladies and gentlemen, if you agree, allow me to share some thoughts of the principles we now as an industry need to consider within this evolving framework around 3 topics. 1, financial stability. 2, fairness, and 3, efficiency. So let's start with financial stability. We should consider strict membership requirements of central counterparties. Clearers, and that includes us as big firms clearing derivatives for other, must be able to support a strong risk management framework. Why? Because we, the membership, ultimately are underwriting the integrity of the CCP structure. The default process. The CCPs should have a very transparent and predictable process that is followed in the event of client and clearing member default. Appropriate levels of initial margin. Central counterparties must not be allowed to compete on margin, and the risk management framework should incorporate feedback from the CCP Risk Committee. And that comes to CCP capital. CCPs are being identified potentially as too big to fail. That means the CCPs need to have appropriate levels of capital and get impacted high in the waterfall ahead of default fund contributions. This means, as an industry, we'd also like to see the CCPs to have some skin in the game. Client segregation options. Forcing clearing members towards a path of super segregation may have unintended consequences of participants withdrawing from offering clearing services. These are themes we should consider around financial stability. How about fairness? Ladies and gentlemen, not all participants are created equally. There is no mechanism in place to differentiate today between the credit quality of users and clearing members in either margin levels or within the default fund. Maybe there's an opportunity to explore this. Risk management. The conflict of interest in managing risk within a commercial entity of a CCP, needs strong and independent governance. And of course, we've touched on transparency on the clearing fees charged by the CCP. And this is particularly in the case where we're talking about derivatives. It would be helpful to have clarity of the split where exchanges have bundled execution and the clearing charge. And it would be ideal to allow for a split of these two functions. And finally, efficiency. Ideally, we all want to maximize liquidity, transparency, and access. We need to have scalable technology solutions to focus on the key market structure challenges of availability, complexity of credit limits, checking, brokerage, and other things. And of course, finally, we all want to have a sensible market structure for the benefit of all of us in the community, and not perhaps just for-profit commercial entities. So with that, I thank you very much.
Wow, thank you very much indeed. Just quickly, Robert, I mean, you stressed the importance of financial stability. We see now that EMIR is on the way. It's very nearly law. It's in front of ESMA. Does that match your expectations, hopes? I mean, it seems, just listening to you, that there's a lot in there that matches your principles.
Yes, thank you, Chairman. I think that is true. I think the opportunity is for us as an industry to try and highlight and flesh out and discuss more of some of these themes that we have discussed. So CCPs having skin in the game, what should be the right level of margin relative to risk level? Should there be high quality membership criteria to participate into the CCPs, given that we have to underwrite all of these? And perhaps the other insight is that it is very helpful to have a legislative framework to give us guidance and in some cases obligations on what we should do. But the other insight, and this is a great example of Europe, is that we as the industry do not need to wait until the ultimate final regulation to start talking about best practice right now. Thank you.
Fine, thank you. As chairman, I'm conscious that the panel has left us with a dangling question, which is Hughes to the CSDs as to what they're going to do about his missing €2 million a year. But before inviting one of the CSD representatives to answer that, are there any questions from the floor? Yes, over there, please. If you could, because of the light, I can't quite see who you are, so if you could identify yourself before speaking, please.
Good morning, everybody. Michael Polito, Head of Risk Management, CC&G, London Stock Exchange Group. Among the regulations, I've seen that we have been discussing about EMIR and its ESMA and EBA follow-ups, and also the CPS SIOSCO has been mentioned. There's another regulation which is lingering around CCPs, which is Basel III, and the new capital requirements for members for CCP exposures. How do we see that third regulatory body as affecting the industry and its balances?
I think it's a question about joined-up regulation, basically. So, Hugh or Urs, would you like to?
Mark, thank you. I can give you a very brief answer on that one, which is based on my lack of detailed knowledge, I think I said before, of those regs. But I was lucky on Monday to be at a meeting with the EBA in London with one of your colleagues, and more importantly, one of Mark's, a chap called Jürgen Hiller, who is, thankfully, a great expert on all of the Basel III side and the link up with CSD regulations and CCP regulations. And supported by the rest of the CCP community there, he was strongly arguing for these regs to be joined up, highlighting the apparent discrepancies between them, and much to the interest of the EBA. So I think it's in all our interests to make sure that we're not having to satisfy different requirements, sometimes conflicting, but even just different requirements across the board. And there is a job for the regulators, ably assisted by experts such as Jürgen, to help us get there.
I can imagine this is probably also going to be something for the OTC panel later, because it's specifically, isn't it, the whole issue of how it affects clearing, or rather non-mandatory clearing. But
it's an observation, frankly, almost across the whole financial world, which is that, not surprisingly, there are a lot of people who want to have an influence on trying to de-risk the financial sector. The financial sector kind of made some mistakes and therefore deserves to have these lectures being made out at times. But let's look at CSD. We've got the CSD regulation, we've got CPS IOSCO. It would be incredibly helpful if at some stage the two were to mirror each other more than perhaps they do now. And so I think as a general statement, whilst we can all moan about there being too much regulation, I think that's A, a fact of life, and B, not totally undeserved, but I think it is quite valid to moan is if we end up having to do 4 things 5 different ways, whereas what we really like to do is to have that level of cooperation and coordination, which I'm not naive enough to think means there's going to be one way of doing things, but let's kind of reduce it and focus on the important things, because I think there is, generally speaking, a danger that people then, if we don't have cooperation, organizations, and I'm not just talking about infrastructure, clearing, settlement, or whatever here, will spend more time on the process of producing data and more data, which frankly I suspect a lot of it does not really get looked at, and less in terms of looking at the mindset and the culture of organizations and as I said earlier, the DNA. And so there's a danger of doing the process but not changing the spirit in which people work. And the more you have to produce the same thing in a slightly different version, I think that increases that risk.
Mark, I think you want to have a word here. And are you going to put Hugh out of his misery on the other
Yeah, he's not getting his money back.
I'll put Hugh out of his misery. I'll answer both questions at once. How about that?
Well, that's joined up thinking, yeah.
Hugh, I guess the answer is I don't really care about the loss of settlement volume. As Tim says, we're going to give it all to the ECB in the context of T2S. And why though don't we care? And that's kind of an interesting point. We don't care. Well, we do, but we don't care fundamentally because that's not the opportunity nowadays that we have to add value. We are increasingly not being paid, and this goes back, probably a decade or more, for settlements as such. We were paid for the ability for a while to immobilize assets. We were paid for a while for the ability to concentrate assets from many different markets in one system, and that gives certain economies of scale. But right now, we would rather focus on helping the market address the concerns that the market has arising from this agenda, and that means capital efficiency. How can people like us best do that? That is in providing solutions around collateral management in the broadest sense, around the ability to deploy collateral easily, the ability to avoid not just the direct costs of collateral fragmentation, that is to say, having to move it through settlement transactions, but more importantly, the opportunity costs that give rise to large overhangs of collateral, i.e. stuff that you could in principle use when looking at your long box, but in reality you can't use because there's no economic way of getting it to where you need it to be, or because there is no feasible way of doing so by the moment in time that that margin is required or that commitment is required. And there's an awful lot that we have done and that actually does together and separately to make that possible. And that will grow because, with EMIR, with Dodd-Frank, depending on your assumptions about implementation, the BIS is saying that that generates around $3 trillion of additional, or of, let me say, of collateral requirements. And they estimate that anywhere between half and 70% of that is perhaps in some way collateralized today. Now, what is quite clear is the habit of giving cash margin, or as one managing director of a CCP said to me the other day, loose change, as collateral will have to change. People will need to deploy securities as collateral to make this a success. And this is something where our part of the industry will be looking to add a lot of value to the market. And that brings me to the point about joined-up thinking. If we say move away from settlements, create opportunities to add value in terms of capital efficiency, in terms of the reduction of market risk, then you also have to be quite careful about unintended conflicts. One unintended conflict, Marta, you've already alluded to, which is T2S says, let's absorb these settlements, let's create scale economy, let's have the CSDs as competing distributors. Therefore, let's have a certain level of concentration and preserve the discipline of competition. This was the great vision, if you like, that sat behind T2S, and the part of it that in many ways is most attractive. Then you turn around on the other side and say, as a result of some completely different regulation, you can't actually move up the value chain. So many CSDs are being told, outsource 60 or 70% of your revenue, but no, you're not allowed to reinvent yourself. So that train wreck is something that nobody intended, but it's there as a result of no joined-up thinking. Another example would be the FTT. We turned around and said, okay, we will, in the name of reducing settlement costs by somewhere between 50 cents across Europe and creating those liquidity efficiencies, we will join this T2S project. We will all work towards that. And we have done for 6 years now. We've got another 6 years to go, but we've worked for 6 years at doing that in order to save 50. And then we talk of a tax that we calculate would generate on the settlements we handle just under 3,000 euros a settlement. That's not joined up thinking. So we have a number of those sorts of conflicts we've got to absolutely iron out. And just one last point. I think we should not forget that infrastructure, and I beg to disagree us, is there to reduce risk. A CSD is there as an alternative to guys walking around the City of London with briefcases strapped to their wrists. That's what we do. And The trade-off is not to move the risk from left to right, but by centralizing risks, do you get efficiencies that ultimately produce an aggregate reduction in the level of risk absorbed by the market, in which case it makes sense to centralize those risks. And that's what the DTC, or the SEC and the Fed are talking about in the context of repo reform, for example.
Thank you very much. We're now at the point of time where it is refreshments, but if there is any pressing question, please raise your arm. I'd like to thank all panelists, actually, because we have other panels coming up later that can take up some of these issues, the CSD panel, the interoperability panel, the OTC panel, and I'm very grateful for Mark bringing a lot of these things for the CSD panel into focus, because sadly you won't be with us this afternoon, but Tim, you will. So, and Marta, are you with us as well this afternoon? Yeah. But any questions from the floor at this point? Otherwise, I'll invite you all to applaud in the usual manner and then go and refresh yourself. Thank you. No? There we are. Thank you.